Hi everyone, this is Jaspreet. I'm going to start this series of videos where I'm going to talk about cryptocurrencies. Um, call it the voyage into crypto metaverse. This is the chapter one. Before we get started, I just wanted to say that none of this is financial advice. It is just for fun, entertainment, and education. So without further ado, let's just get started. Let's first talk about the first and foremost cryptocurrency, which is Bitcoin. So what is Bitcoin? So even before we talk about Bitcoin, let's quickly talk about what is money. So what do you do with the money? What is it? So basically money is a medium of exchange. So you have money, you want to get, for example, an iPhone. So you just exchange that money with the iPhone. And also you can buy various stuff with this. You can buy food, you can buy commodities and all that. Uh, so that's the medium of exchange. So, and also it is supposed to be a store of value, but is it really a store of value? We'll talk later about that. So what is Bitcoin? So Bitcoin, it's a form of money. It at least it was supposed to be a form of money. It was introduced in 2009 by a person called Satoshi Nakamoto. Uh, Maybe he was a person, maybe he was a group of people. No one knows. So he was anonymous. He published a paper. He or she or them published a paper called Bitcoin peer-to-peer electronic cash. So it is electronic, it is digital, it is decentralized, it is peer-to-peer. So what does that mean? So anyone can send money to anyone or Bitcoin to anyone without any third parties involved, without any banks involved, or any kind of other third parties involved. And also it is borderless. So it works all across the world. Anyone can send Bitcoin to anyone across the world without any third parties involved or any banks involved. So, and also it is self-custody. So what do I mean by self-custody? So it's, for example, the dollars in your bank account. So they are actually held by the bank. So you are not actually holding your dollars. Whereas with Bitcoin, you are holding your Bitcoin yourself. No one else is holding your Bitcoin. There are custody services. We will talk more about that, but it is recommended to hold your Bitcoin yourself in your own wallet. I'll have another video where I'll talk about wallets and what all kinds of wallets are there. But for now, understand that Bitcoin is self-custody. Bitcoin is supposed to be self-custody. Um, so Bitcoin basically it's again it's digital. It's you can call it the internet money. So it's the money on the internet. So you can transact with it. You can buy stuff with this, and you can send it to someone. You can even work for Bitcoin. You can uh, say, okay, I'll do this, but I accept Bitcoin in return. So uh, but if you talk about legally, so Bitcoin uh, is not legal tender in many countries. It is accepted as a legal tender in some of the countries, but not everywhere. Uh, so many countries just treat it as an asset, just like a house or a stock. Uh, I'll go into more detail later when we'll talk about how is it different from, say, stocks, right? So let's just go next. So now next point, why do we need Bitcoin? Um, so money as we know it, the fiat currencies, so it's centralized. There are certain problems with it. It's limited to a region or a country. And when you transact across countries, you need to go through a number of third parties, a number of banks, and then you need to pay fees and charges. And also it causes a lot of delays. It can take days if you want to transfer money from one country to another country, and you need to take into your mind the exchange rates and all that. And then uh, yeah, so it may not be practical to send small amounts of money. For example, if you're just sending $100, so it it doesn't make sense, because uh, sometimes if the banks and the third parties can charge like $50, $60 or more, or even $100. So you will not get your $100 when you transfer it across countries. So and also these fiat currencies, they are controlled by an entity, for example, the central bank or the governments. So those all are problems. But another major problem is that the supply of the fiat currencies. There is a chart on this slide which shows the last 10-year supply of um, United States dollars. So you can see that all of a sudden in 2020, when COVID hit, the pandemic hit, the money supply just increased, like it just went up. So, so what happened there? So basically, United States just decided to print a bunch of money, a bunch of dollars, and give it to people. And I believe this is the situation with other currencies also. Uh, Wherever the governments decided to give money to the people, they just printed money out of thin air and just started giving out all these checks. So now the problem is that the supply actually kind of ballooned. And so what is the problem with that? So everyone gets the money. So when you have more supply, obviously, so what happens is that the inflation increases. So why inflation increases? Because you have increased the supply of the money, but uh, the supply of the goods and services, that hasn't increased, or maybe that may have decreased during the pandemic. Uh, Production may have decreased, or there may have been supply chain issues and all that. So the goods are the same or even less. So obviously, when there is something less and the supply is restricted, and the demand goes up or something like that happens, so obviously the prices of the goods and services will start to increase. And when everyone has that kind of money, they will try to spend that money. So that is what has happened. And because of this huge increase in the supply of the money, or the United States dollars, the inflation started increasing. And everyone is aware what is happening these days. Um, so the things are costing more in very short, I would say that. So 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 this is the problem. So the supply is controlled by a centralized entity, in this case the central banks. So they can increase the supply, and the dollars that you are holding, uh, they are actually reduced in value, to say that. So why they reduce in value? Because the same dollar is not able to buy the same amount of goods and services anymore. So the value has decreased. So when you're holding these fiat currencies, what's happening is that over the period of time, the supply is increasing. And also it's actually controlled by someone. It's controlled by the central bank. So they can just increase the supply, and the dollars that you are holding, they will decrease in value. So so it's fiat currencies, you can say that they are not a good store of value. Uh, so how Bitcoin actually is different, in that in those terms, Bitcoin is fixed. Bitcoin supply is fixed. So there can only be 21 million Bitcoins ever. It cannot be more than that. So at the moment, the supply is around 18.9 mil. So and I'll talk a little bit about how Bitcoin works. So basically, Bitcoin, as I explained before, it's a decentralized cryptocurrency. So by crypto, I mean it's it is actually controlled through an algorithm, and the algorithm actually uh, say so. It is based on kind of public-private key cryptography. There is a public key and there is a private key. So the person who holds the private key owns the Bitcoin held by that private key. So and the history of the transactions and the history of the ownership is held on a database called the blockchain. So I'm just generalizing it too much. It's not exactly a database. It's a so but to simplify it, you can call it a database which holds all the transactions. And the how it's different is that from a database is that it's actually, so you have one block of transactions which contains say 100 transactions or whatever number of transactions it can contain. So there is a limit on that, and then uh, the next block actually points to the previous block. So there is a chain of blocks. So that's why it's called blockchain. So every new block that gets created that has certain number of transactions points to the previous block. So the blocks are actually chained together. So they maintain the complete history of the transactions. So for any particular address, that history is maintained. So that way it maintains the history of all the people that are transacting on the blockchain. So, but now that is just one piece of the puzzle. And then we have nodes. So what are nodes? So nodes are basically, they think of them as kind of computers that are processing those transactions, that are holding that blockchain, and that maintain the validity of the blockchain. And also they uh, so the set of nodes form the Bitcoin network. And whenever a new transaction is propagated, uh, so you want to send money from, say, I want to send money to one of my friends. So what I need to do is I need to create a new transaction with, I can say that, okay, I'm sending to this address. So I'll talk more about what is an address later, but let's just assume, okay, it's your friend's address. So you want to send um, some Bitcoin to your friend. How that happens, you create a transaction and then you propagate that transaction on the network. And then there are a set of nodes that form the Bitcoin network. They process the transaction, and then all of the nodes must agree on the transaction. So that is called the consensus. So not all of the nodes need to agree, only 51% of the nodes need to agree. So when there is a majority, so the consensus gets formed, and then those transactions get mined. So I'll talk more about mining, but yeah, that's the way it works, is that you propagate a transaction, and then some node processes a transaction, and then a new block is proposed. And then when 51% or more of nodes agree on that block, so that block gets mined. So by mining, I mean that the block gets into the history of the blockchain. And then more blocks so when more blocks get mined, so they sit on top of the previous blocks. So that way they just form so that blocks gets kind of finalized. So once there are more and more blocks on top, so it gets harder and harder to change the block that is underneath. So that cannot be altered. So so that's the way it works. So, and then these full nodes are also maybe called as miners. So the miners are running these nodes, and then they are actually so then the nodes are creating these blocks, and when the blocks are created, uh, whichever node is able to create that block, or so it's a race between all the nodes to create the next block. So whenever a block gets created, the node that created that block gets rewarded. So the current block reward sits at 6.25 Bitcoin. So whenever a new block gets created, this reward is given to the node that was successful in creating that block. So, or mining that block. So that is the mining reward. So I'm simplifying too much. So it's not exactly that, but it gives you the idea. So uh, so that block rewards now, the initially when it started in 2009, the block rewards were at 50 Bitcoin per block. Uh, so the frequency of the blocks is like every 10 minutes. Uh, so every 10 minutes, a new block gets created with the set of transactions, and then whichever node is able to create that block or is successful in creating that block, that node gets that reward. So in 2009, that reward was 50 Bitcoin. Then there is an event called halving, which happens roughly every 4 years, or 210,000 blocks. Uh, so so every time that those 210,000 blocks get mined, the block reward actually gets halved. So initially it was 50, then after 4 years, it got halved to 25, then to uh, 12.5, and now it's sitting at 6.25 Bitcoin every block. So this is the way it works at a very high level. So you may want to dig deeper into this, but um, this is what I just wanted to show you. So that's it for the chapter 1. I will talk more about Bitcoin and the wallets and all, but for now, uh, that's it. Thank you and bye.